Dear students, welcome you all to the session 7 video of chapter 2 Capital Structure Financial Management 5th semester BCom. The previous session 6 of the chapter Capital Structure, we have worked out problem in determining the operating leverage, financial leverage and the combined leverage. In this session, we'll work out problem wherein we'll determine the earnings per share. The problem number 3. The EBIT of the firm is rupees 10,000. The firm has 5% bonds aggregating rupees 40,000 and 10% preference shares amounting to rupees 20,000. What would be the earnings per share? Assuming EBIT being rupees 6,000 and rupees 14,000, how would the EPS be affected? Tax rate is 35%. The number of outstanding ordinary shares is 1,000. So the information given here regarding the ordinary shares or equity shares, the amount is not given. Number of ordinary shares or equity shares is 1,000. When preference share capital is 20,000 and the preference dividend rate is 10% and the bonds the amount is 40,000 and the interest rate for the bond is 5%. The EBIT of the firm is rupees 10,000. That is the first situation. Then the EBIT changes rupees 6,000 and again the EBIT changes to 14,000. How would the EPS be affected? We need to find out. The tax rate is given 35%. Now let us find out the earnings per share. First situation is when the EBIT of the firm is rupees 10,000. We'll prepare a statement of income and find out the surplus profit. So EBIT is rupees 10,000 less interest. Interest on bonds, 40,000 is the bond amount and 5% is the interest. 40,000 multiplied with 5%, 5 by 100, you get 2,000 rupees. So earnings before tax is equal to 10,000 minus 2,000, which is equal to 8,000. Less tax at 35%. 8,000 rupees multiplied with 35%, we get 2,800. So earnings after tax is equal to 8,000 minus 2,800, 5,200 rupees. Less preference dividend. So preference share capital amount is 20,000 and the dividend rate is 10%. 20,000 into 10%, 2,000 rupees. So surplus profit is equal to 5,200 minus 2,000, which is 3,200. Now, earning per share is equal to surplus profit divided by number of equity shares. 3,200 divided by the number of equity shares. Ordinary shares which is given 1,000. So, 3,200 divided by 1,000. Earning per share is equal to 3.2. Now, let us find out the EPS in the other two situations. That is when the EBIT is rupees 6,000 and when the EBIT is rupees 14,000. So, the first situation, EBIT is 6,000. Interest is same rupees 2,000. 40,000 into 5 by 100. Then EBT is equal to 6,000 minus 2,000, 4,000. Tax at 35%, that is 1,400. Earnings after tax is equal to 4,000 minus 1,400, 2,600. Less preference dividend, it is 2,000, 20,000 into 10%. So the surplus profit is equal to 600. Now, when the EBIT is 14,000, we'll calculate EBIT is 14,000, interest remains the same 2,000, earnings before tax is 12,000, tax is 35%, that is amount is 4,200, 12,000 into 35%. So the earnings after tax is 7,800, less preference dividend 2,000 rupees, surplus profit is equal to 5,800. Now, the earning per share, the first case, surplus profit divided by number of equity shares, 600 divided by 1000, 0.6. The second case, earning per share is equal to 5,800 divided by 1000, which is equal to 5.8. This is problem 3. Now, let us go to the next problem, that is problem number 4. We'll read the question. The company has 10% debentures amounting to rupees 1 lakh and 5,000 equity shares. tax rate is 35%. Calculate EPS if the EBIT is 50,000, 30,000 and 70,000. So information given here regarding the equity shares, number of equity shares are given, the amount is not given, and then debenture, 10% debentures amounting to rupees 1 lakh. And we'll have to calculate the EPS if the EBIT given in three different situations. When the EBIT is 50,000, when the EBIT is 30,000, and when the EBIT is 70,000. So we'll prepare a statement of income together for all the three situations, and we'll find out the surplus profit. So statement of income. So the three situations, EBIT is 50,000, EBIT is 30,000 and EBIT is 70,000. The first situation we'll see, EBIT is 50,000 less interest debenture, 1 lakh debentures and 10%, 1 lakh into 10%, 10,000 rupees. So earnings before tax, 50,000 minus 10,000, which is equal to 40,000, less tax at 35%. 40,000 into 35%, the amount is 14,000. Earnings after tax is 26,000. So in this case, preference dividend is not there. That is, there are no preference share capital, so there is no question of dividend. It is 0. So the earnings after tax itself becomes the surplus profit. So 26,000. So surplus profit is equal to 26,000. Now we'll come to the second situation. EBIT is 30,000. Then interest remains the same, 10,000. EBT, earnings before tax, is 20,000. Tax is 35% on this 20,000 rupees, that is 7,000. Earnings after tax is 13,000. Since there is no preference dividend, earnings after tax itself is the surplus profit or the earnings available to equity shareholders. The third situation, EBIT is 70,000, interest 10,000 rupees, earnings before tax is 60,000, tax is 35%, which is 21,000. 60,000 minus 21,000, the earnings after tax is 39,000. The earnings after tax itself is the surplus profit, 39,000. Now we'll calculate the earning per share. So earning per share is equal to surplus profit divided by number of equity shares. So first situation, 26,000 divided by the number of equity shares, 5,000, which is equal to 5.2. The second situation, 13,000 divided by 5,000, which is equal to 2.6. The third situation, 39,000 divided by 5,000, which is equal to 7.8. Now we will just find out the financial leverage. So financial leverage can be computed with the formula EBIT divided by EBT. Since there are no preference dividend, we can calculate with this formula. 50,000 divided by 40,000 is equal to 1.25 times. So what is the meaning of this 1.25 times? For a change in EBIT, the EPS will change 1.25 times. Now we will just see how this works. EBIT was originally 50,000 rupees. There was 40% increase in EBIT. Isn't it? The new EBIT is 70,000. 50,000 plus 50,000 into 40%. That is 20,000. 50,000 plus 20,000. New EBIT is 70,000. So what should be the change in EPS? EPS change should be 40%, that is the increase in EBIT, into financial leverage, that is 1.25 times. So 40% into 1.25, which is equal to 50%. So what does it mean? For a change in EBIT, the EPS will change 1.25 times. So if it changes 40%, how much it will change? 40% into 1.25 times. The EPS will increase by 50%. Let us see whether the EPS has increased by 50% or not. Now, what was the EPS in the situation? EPS was rupees 5.2. When there was 40% increase in EBIT, the EPS should increase by 50%. That's what we have calculated using the financial leverage. The new EPS is rupees 7.8, isn't it? So we'll just see whether it is true. 5.2 plus 50% of 5.2. that is the increase. 5.2 rupees plus 2.6, which is equal to 7.8. So the new EPS is 7.8, isn't it? We know it. You can just look back. So new EPS is 7.2. So this 7.8, the 7.8 is the new EPS, which is 50% increase in the previous one. So when the EBIT increases by 40%, the EPS will increase by 50%. How we have come to know about this? We came to know that it will increase by 50% with the help of leverage. So leverage, financial leverage is equal to EBIT divided by EBT. 50,000 divided by 40,000, 1.25 times. So there will be 1.25 times change in the EPS, which we have seen, isn't it? 40% increase in EBIT, there was 50% increase in the EPS. This is the concept of financial leverage. Hi students, I hope you have understood this. If you have not understood, please do inform me, ask the doubts. Okay, thank you.